Canada's annual inflation rate slowed to 2.5% as of July. It was on par with expectations, and it's the slowest annual increase in inflation since March of 2021. Our guest says this could open the door to a faster pace of rate cuts by the Bank of Canada. Let's bring in Veronica Clark, economist at Citi. Veronica, great to see you. Thanks for joining us. What jumped out for you with these inflation numbers?
Yeah, I mean, this was certainly, more favorable slowing for inflation. It was actually even a bit softer than what I was expecting. So in that sense, definitely getting more progress back to 2%. I didn't change any, expectations for the BOC on this number. I think it does, of course, make it very likely that we will see them cutting again in September. Just penciling in a 25 basis point cut in September. But I do think based on, not so much the inflation data, but maybe the activity data, the labor market data, if things are slowing faster, we might see bigger cuts down the road.
And you think that there's a possibility of a 50 basis point cut in October?
Yeah, that's essentially my base case, and that really does come down, I think, to what we're seeing in the labor market, both in Canada but also in the U.S. I think the Bank of Canada has been expecting that, as inflation is slowing and as rates are coming down, that will help support the economy and come out of this slow patch that we've been in for the last year or so. Growth will pick up in the second half of the year, but what they're not expecting is slowing in the U.S. And we've definitely seen, a rise in the unemployment rate in both countries, potentially a softer growth picture as we're getting into the second half of the year, and that would support larger cuts. I do think they'll cut 50 basis points in October.
I know you're not a stock analyst, but some airlines such as, notably Southwest and Delta have talked about possibly growing competition, lower ticket prices. So we did see prices for recreation, travel go up, but not by as much as you would have expected.
Yeah, exactly. This is the time of year. This was a reading for inflation in the month of July. It's the summer. People are traveling. This is the time of year, when prices for, airfares and recreation, travel services, all of those increase. And they did increase in this July reading, but by less than they usually would in July. It does feel like, maybe some of these more discretionary services, spending items, there's just not a lot of demand to support, big price increases there.
What about shelter? Because that has been really I was going to say the fly under the saddle, but that's not a metaphor. The fly in the ointment. That's been keeping inflation high. Is there any sign of shelter cost inflation coming down?
Yeah, it is an interesting one. That's been a really big contributor, of course, to inflation over the last couple of years, and it is probably still, the source of the biggest upside risk if we were going to consider upside risk to inflation still. But I think it is slowing. We actually saw in today's number, and even in the last month's reading for the month of June, some slowing in rent inflation, which is of course a good sign. Home prices, which are a bit mixed. That component, tied to home prices was pretty soft in July. But we actually got prices on new home prices at the same time as CPI this morning, and those were a bit stronger. So maybe there's still some upside risk there, but I do think even that component is starting to slow.
So students are heading to their new accommodations. I suppose parents are helping them to buy stuff. Would we be well advised to hold off on our purchases? Are we going to see stores cutting prices to shift inventory? Are there too many goods out there, do you think?
Yeah, I mean, the good story, you never actually want to see, outright disinflation. That's really not a great signal for what's happening in the underlying economy. And we do actually, globally still see some pressures on goods prices. Global shipping costs have come up a lot. So I wouldn't, write off that, upside risk altogether. But goods and, those discretionary, travel services, that's where it is easier for people to adjust their spending patterns. And that's where we are seeing a lot more of this disinflation.
Because I believe there's been right now there's practically no inflation in goods prices.
Right, exactly. Yeah, we're experiencing that in the U.S. also. Initially that was supply chains normalizing and correcting, but now it just does seem like consumers are pushing back against those higher prices.
Actually, I buy whatever I can on eBay or Facebook Marketplace, or I don't buy new if I can avoid it.
Yes.
I'm a stingy old. What about we looking at a substantial weakening there?
Sorry, I missed that. You cut out for briefly.
Sorry, the labor market, the employment situation, is that heading downward right now? Are we going to see consistently rising unemployment, for example?
Yeah, I think that is very quickly where the focus for central banks is shifting. Of course, employment's not part explicitly of the Bank of Canada's mandate, but we have seen, in both the U.S. and Canada, this more consistent rise in the unemployment rate recently. Of course, the unemployment rate was stable at 6.4% in July in Canada, but that's still a pretty elevated level. We have seen, more months where we've gotten outright job losses in the monthly employment data. So it does feel like we're on the brink of maybe a potentially weaker labor market.